PayCom is an amazing company trading at the same price it was trading at in 2019. Absolutely insane. The stock has been beaten down a lot. A lot of people on Twitter have been buying it. A lot of super investors have been buying it. And I just see a lot of people buying PayCom, which is normally a sign to avoid the stock. But again, I decided to check it out for myself. Maybe I would even buy PayCom. And I have to admit, I'm extremely impressed. And I see this is a massive overreaction with the stock. Things are a little bit bad, but they're not as bad as I'm seeing in this chart for the stock to be trading at the same price it was trading at in 2019, despite the fundamentals have improved a lot and the company is just amazing. So I'm going to talk about it in this video and let you know if PayCom is a buy, is it some kind of a generational buying opportunity that you don't get very often, a meta kind of opportunity, or is it maybe just a value trap and it's likely going lower? This is what I'm going to discuss. Now, the main reason PayCom is going down, this is what I saw from my analysis, is that the growth is slowing down. And PayCom was priced at a very high multiple. And these software companies have been growing forever. And the growth has started to slow down. PayCom was growing at 45% in 2016. It went to 30%. The stock started struggling in 2019. Then 14%, 20 to 30%. The market saw the growth came back. It didn't come back. They're guiding for 2024 around 10%. The analysts are expecting between 10 to maximum of 13% from the future. Now, whenever the growth gets cut from 30% to 10%, the stock has to take a hit. But if you look at the fundamentals and you look at everything else, the stock is reasonably valued for 10% growth with everything else that the company has. But the slowdown is a pretty big slowdown, and it's a little bit concerning, especially if you look at the total clients that PayCom actually has. They had 33,875 in 2021. It went to 36,500. And from 2022 to 2023, it only increased like 300, which is almost nothing. So it's not at the same pace it increased from 2021 to 2022. So the pace of increase has been slowing down. Annual revenue retention rate from 94%, 91% in 2023 was 90%. So the stock, I mean, should go down. It should go down on such numbers. It should go down on the growth pulling back. But I think it's an overreaction again. The company is trying to do a lot of things to offset the decline in growth, to try to grow again. They launched something called Betty, and they really focused on it, which is more, as I understood, some kind of an AI thing, software to manage human resources and other things. But I mean, it's not bad, but they still have a lot of competition. This is the problem. That you have companies like PayCor and other smaller companies. They are actually competing with PayCom, offering lower prices, more competitive, packaging and stuff. So it has a lot of competition. And PayCom, in my opinion, is a well-known company, but it does not have such a massive competitive advantage over other companies. And this is just a part of investing in these human resources stocks. Some of them have a good name, they have a good software, but a lot of smaller companies have a software too. And maybe some smaller businesses, they care more about the price than the value that they're actually getting. And this is where PayCom is falling behind competition, in my opinion. Now, the good thing is about this business is that it's extremely sticky. It's a massive headache to move from PayCom to another provider. So PayCom is not really struggling with retaining customers, it's more struggling with adding new customers. And this is why they're launching new products like Betty, which is so far looking like a success. They're also launching in Canada. It was mainly a US-based company. In 2023, they launched in Canada. They launched later on in Mexico, and they're starting to expand internationally for them to revamp the growth within PayCom. And all these steps are amazing steps that I'm seeing the company take to try to improve the growth. It's not like the company is just sitting and doing nothing. They're making initiatives. They're trying to do stuff. But this is pretty amazing. So we did see that the growth has declined. We saw everything that's happening with the clients and all that kind of stuff. Now, if we look at the multiple of PayCom, PayCom is trading at 18 times earnings. And here I'm using, non-GAAP. I'm normally use GAAP for that stuff, but this year in Q1 they had a one-time expense within sales and other general administrative. They fired some employees, one-time expenses. So GAAP looks very different. It looks higher than it is. So I use non-GAAP. Non-GAAP is trading at 18 times earnings. The stock went from 28.7 for the mean to 18 times. It was around 26 times. It topped at 26, 27 times. It used to trade at 43 times. Now it's trading at 18 times earnings. Now, if I just look at a company, 18 times earnings for 10% growth, if I don't know anything else, To me, that's very fairly valued. For 10% growth, I'm paying 18 times earnings. This is not expensive at all. Okay, now I'm gonna look at a little bit more metrics. For 18 times earnings, we're getting 10% growth. Well, what else are we getting? We're getting a company that has 98.4% in recurring revenues. 98.4%. This is amazing. And if a company has recurring revenue, it should trade at a higher multiple. So now we have 18 times earnings for 10% growth. 98.4% of this revenue is recurring. The company has zero debt. They have some short-term stuff and lease liabilities, but long-term debt is zero. And they have $371 million of cash. And this is not just that. You're also getting a company that has pretty high net income margins. For 2024, expected to be around 23%. You're also getting a company that has high return on invested capital, around 29% return on capital. Pretty amazing stuff. You're also getting a company that you have stock-based compensation, of course, but it's not eating up the shares outstanding because the company is buying back stock. It's sustaining the shares outstanding, and they even started to slightly go down, and they currently have a buyback program. So I'm getting all these things for 18 times earnings. I'm getting 10% revenue growth, which should be sustainable. I'm getting 98.4% recurring revenues. I'm getting, zero debt, 371 million of cash, 23% net income margins, 44%, I think it was, return on capital. And I'm getting all these things with a company that actually has a plan to start growing again, launching new products, going international. So I see amazing things. But there's two things that I really don't like with PayCom. And I'm going to tell you what they are. The first one is the stock-based compensation. I'm not a big fan of that stuff. That's why I don't really invest in software companies, tech companies, all these things. I really don't like that stuff. But this is how it is with PayCom, and has increased a lot from 2022 to 2023. So you shouldn't be using, free cash flow numbers because it's a huge part of the free cash flow. So it's not very accurate. Another thing that concerns me is the CEO, or you could say the co-CEO, Christopher G. Thomas, has resigned. And this is why the stock went down I think 6% on Friday. So he has resigned. Now the other CEO has been selling stock like never before. I mean, he's not even buying. You could look at this chart. As the stock is going down, this guy has been selling nonstop. 300,000, 300,000, 320,000, 328,000, 332,000, 350,000. He's been selling like never before, just selling. I mean, if I saw insiders buying here, I would be much more encouraged. If I'm looking at this chart and I see the CEO selling in this chart, in this movement, that concerns me a little bit. I have to be honest. Although whenever I look at insider selling, so I see, for example, his name, and I try to see if he actually bought any stock before, because you have some insiders that just keep selling. And if all they did was ever just sell, they never bought anything, I cannot see a pattern that this guy saw the stock was undervalued, he bought, he saw it's overvalued, he sold. So he never really bought any stock. No one has bought stock from PayCom because they have stock-based compensation, they've been selling it. But when I see the CEO selling it at this price recently in this decline, you could see the chart, it concerns me a little bit, I have to say. And these are two things that concern me with PayCom. But I have to admit, I look at the stock, I'm like, is this too good to be true? It's amazing. You're getting amazing value for 18 times earnings. And if you want to use GAAP without taking off the general administrative, it's like 20 times earnings. Again, 20 times earnings for all that stuff is not expensive at all for PayCom. I would say PayCom stock is a buy. I'm not seeing anything crazy. I'm seeing a massive overreaction from the market. But seeing the CEO selling, I mean, I'm not surprised if it goes lower. I know it's crazy. But this is what happens. This is how the market overreacts to the downside until you get some kind of good news. Maybe you get a beat on earning, you get better than expected guidance, they raise guidance, they initiate a huge buyback program, something happens, and then or some popular investor gets a stake or some activist. This is when you have such reversal to the upside. But for now, I mean, I wouldn't be surprised if PayCom keeps going down or it stays flat from here. Or, I mean, I don't know what happens, but I like what I'm saying. And this is just my opinion on PayCom. I hope you enjoyed the video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.